Are you looking for some good, steady, long-term capital appreciation and dividend income opportunity? Today, I'm going to go over residential real estate investment trusts or REITs. Now, these residential REITs are companies that own and manage, say, apartment complexes. These are fairly stable, fairly steady investment types. Everyone is always going to need a roof over their heads. Now, when you put it that way, clearly, this seems like a very stable opportunity for an investor. So I'm going to go over the sector. I'm going to use my favorite tool, fast graphs, for this approach. I'm going to quickly get a sense of which of these investments I like the looks of. And then from that, these are going to be my candidates for further investigation and further, more deeper investment analysis before I pull the trigger and actually begin to make some investments in these companies. So let's get into it today. Okay, so residential REITs. What I've done is I've taken the US exchanges and I have taken all the residential companies here. Now, what I've done is I've pulled up 22 companies using this screener. Now, this is more than what I'm interested in looking at, I've got to be honest. So, a couple of things that I can do here that I do like about fast graphs is, for example, I can create a view and it enables me to basically change what information and data I am looking at on this table here on the screen. So here, for example, I've got long-term debt to capital, credit ratings, AFFO over 20 years, current WACC, weighted average cost of capital, and dividend yields. Now, what I can do here, for example, is I can quickly isolate perhaps some of the companies that I'm interested in looking at further. So, for example, I'm not interested in, not interested in looking at these companies here without a dividend yield. I'm going to delete those tickers. What have I got here? Credit rating. Now, I noticed down here there are a couple of these stocks, UMH, for example, Clipper, that could be interesting. But for the purposes of this video, I'm actually going to eliminate these stocks here that don't have a credit rating. Noting that one also not rated. Let's give it a minute to refresh. Okay, so now I'm left with the residential REITs. I've got a much tighter range here. These are companies which we might all be familiar with to some degree. Sorting by dividend yield, they range from about 2.5% to 3% through to about 5%, which is probably what I'd expect to see. Credit rating ranging from BBB to A minus, pretty much what I expect to see. And long-term debt to capital ranging from mid-30s through to mid-55. Now, this is also interesting. So I've had positions in the past in Essex property at 53% long-term debt to capital. And I know as well, Sun Communities and Invitation Homes are also fairly high there. I think these here are probably going to be the better options or the sort of safer options in terms of the long-term debt to capital. And as well as you can see here, the credit ratings for A minus are all in the sort of 30 to 40% long-term debt to capital ratio, which is also very interesting. Now, what we can do here is we can select these items and I can create a new portfolio, and I'm just going to call it selection. So I can create a portfolio. I can edit the portfolio. I'm just going to call it a selection here, and then I can simply zip into the portfolios. Now, what I've got is I've got this set to AFFO view. Going to go through ticker by ticker alphabetically just to keep it simple, and I'm just going to go over a little bit about what I'm looking at here. So first of all, AIRC Apartment Income REIT. Relatively short history here. I think it's got the highest dividend yield of the bunch, but also, as I said, very short history. But it is S&P credit rated, BBB, got a reasonable market cap of 4 billion here. And despite the fact there's very little information here in terms of the analyst scorecard, so we're not talking about exactly a very worthwhile set of data here. But certainly if you're looking at 1 year, both times they have hit the analyst expectations. And there's a reasonable number of analysts also providing estimates here as well. In terms of the forecasting calculators, it's hard to say what this company should be trading at. I certainly don't think it deserves a 23 times price to AFFO ratio. But certainly if they do well here, I think an 18.74, for example, might be reasonable. And if this happens, we're talking about a 17.3% rate of return. We can see here as well that the analyst estimates have been fairly steady over the last 6 months. And this could be an interesting case for a little bit further digging. As I say, it's not one that I'm familiar with. Have they been increasing their dividend a lot? Not a huge amount, so nothing's in the 2023 financial year, but a moderate increase here in the 2022 financial year. AMH, American Homes. Quickly, just looking down at the analyst scorecard, we can see a fairly good set of estimates here, 2 years forward. 20% margin of error, 100% of the time they're hitting analyst expectations. And we can see there's a reasonable number of analysts as well reporting. Now, they do have a couple of misses here in the 1 year forward. Now, if I look here on this table in particular, these misses were 10 years ago, 8 years ago, 10 years ago. Since that time, the company seems to have stabilized quite a bit and probably providing better guidance as well to analysts, enabling them to make better decisions. Overall performance, we've seen some volatility here in the dividend growth, and it varies quite a bit. So it's a low dividend yield now, but also a couple of years of good growth here. But there's also been years in the past as well with no dividend growth. So do keep that in mind. Forecasting calculators. Normal multiple has been trading at 25 times. I think that's a bit rich. But certainly here, 11 analysts reporting to the end of 2025. I think 25 times, I think this is a good investment potential here, but I do think that's a little bit rich. But if we say, hey, look, 23 times price to AFFO ratio, it substantially drops the current rate of return here, basically because of the current prices. So it's something to think about. I don't think it's going to be a big earner, but I do like the long-term debt to capital ratio here. Stability here in the AFFO estimates over the last 6 months looks good. And there's an expectation here by the analysts that dividends are going to be raised as well, which is also quite good to see. Avalon Bay Communities. So we can see here in orange the AFFO level. It's mostly increasing. It's had a bit of a dip since COVID. It seems to be going up again. Some expectations here for some fairly high growth in 2026. We can talk a little bit more about why that might be. But certainly one thing here, looking at the analyst scorecard, we can see some fairly good. 2020 is a miss there. 2021 is a miss 2 years forward. But generally reasonable forecast accuracy there for the analysts. Long-term performance, it does have a long history here. We can see in the last few years, they've sort of got low to mid-single digit dividend increases each year. Sort of a 4.5% compounding. And that is on top of the dividend yield of about 3.7, so it's not going to be a huge income earner. If you look at the normal multiple again, I think 21 times is a reasonable multiple. This is a $25 billion market cap, reasonable long-term debt to capital ratio. I do like the S&P credit rating of A-. Looking at the end of 2025, if they do return here to a 21 times price to AFFO ratio, we could be looking at a 17.3% total annualized rate of return. And we can see that these AFFO estimates have been fairly steady, and we can see some reasonable expectations here from the analysts in terms of the dividend increases as well. A Camden Property Trust is one that I am looking at a little bit more closely. I will do a more detailed video. First off, S&P credit rating A- again, long-term debt to capital ratio of about 40% seems safe. Normal price to AFFO ratio of about 20 to 21, which is good. Dividend yield about 4%. That's looking good. All long-term performance. They do have a long-term history here. The dividend increases have been choppy over time. There's been decrease here so that's a bit of an anomalous event. But if we look down these dividend payments, 2.64, 2.8, 3, 3.08, 3.2. It's been increasing other than the special dividend payment there. I'm not familiar with what was going on there. But that looks like very much a one-off dividend payment that I'll just ignore from these calculations. We can see here that the overall rate of return has been quite low compared to the S&P, and this is with dividends reinvested. Though it does spin off more in total dividends than the S&P investment would. Dividend scorecard looking good 2 years forward with beats and the forecasting calculator here, normal multiple. Looking out to the end of 2025, a normal multiple of about 23 to 24, I think is probably a bit rich, but even if I went here to a sort of a 21 times price to AFFO, which I think is reasonable, we're talking about an annualized rate of return of about 21%. Now, there's a couple of things to note here as well with Camden Property Trust is the AFFO estimates have decreased quite a bit here over the last 6 months, so that's important to note and think about. What that means is it means that analysts are now expecting in 2024 a moderate decrease, a very minor decrease here in the AFFO and a very minor increase in 2025. So I'm not talking here about a very good long-term or short-term next 2 years increase here in AFFO. Long-term expectations here for AFFO growth, there's only one analyst here, so take this with a grain of salt, but they're expecting about a 5% AFFO change year on year. I'm not sure about that. I mean, if I look back to here, the overall past performance there have been periods here, 13%, 19% AFFO increases, but also -4, 5, 8, 4. So it's possible that we'll get a 5% AFFO increase. It is definitely one that I'm going to be looking at more. Now, obviously, I think if we'd bought here at the peak, we probably deserved to lose a fair bit of money. I think this was horribly overvalued here at sort of 37, 36 times on a price to AFFO ratio, despite the fact that there was some good growth here coming out after the COVID pandemic crash. But here, it's looking like it's near this orange line, which in my mind is going to, well, you can see it hasn't really happened here since the end of the global financial crisis back in 2009. So it's quite close to the orange line. So it should represent a reasonably good fair value entry point here. It's not heavily discounted, but I think there's some opportunity here. This will be one that I'm taking a better look at in the future myself. Element Communities, this is not one I'm familiar with. In my mind, the AFFO trend here is very much in the wrong direction. It's going downwards. So this is one of the reasons why I do like the visual representation here in fast graph. So I can very quickly see this is probably not a company I want to be investing in, despite the fact that it's got a dividend yield here of about 5%. Triple B credit rating is okay. Long-term debt to capital rating is reasonably good here in this ratio. Forecasting calculators. So if you're looking at the normal multiple here, again, it looks like it could be going up, but this long-term trend appears to be fairly weak. We can see quite a bit of weakness here in the last 6 months in terms of the AFFO estimates being revised downwards by the analysts. So it's quite possible that these could revise downwards further. We can see some expectation here of dividend increases, but again, if you go back to the historic tab, we can see that there's been quite a big cut here in dividends over time as well. And we can sort of see the price action as well has been fairly, to say the least, it's been fairly stable, with a slight sort of downwards trend here as well over time, which mirrors essentially that downwards movement in the AFFO. So for me, I'm not going to spend any more time looking at this option. Equity residential is another interesting option here. Now this is A- credit rated, about 40% long-term debt to capital. We can see here fairly good analyst scorecard as well. And also a fairly good dividend yield of about 4.5%, which is quite reasonable. Now, how has this company performed? So it's got a reasonably good track record here. Again, there's an anomalous dividend payout here in 2016. But if we look beyond that, the dividends mostly been fairly stable, with an increases here. Recent increases have been low to mid-single digits here, and the overall long-term compound growth rate's been fairly weak overall. Now, as well as this, you can see that the performance level down here compared to the S&P 500 has not been incredibly good either, but it has spun off more cash. Analyst scorecards. So the misses here on the 1 year forward were back in 2013. Seems to be more stable there. 2021 here for the 2 year forward. So post-COVID pandemic, I think that's been a reasonable one to forgive them on missing. Forecasting calculator. So a normal AFFO has been about 23 times. Even if we discount this down to an expectation, I think, of about 20 to 21 times, we're talking about a 14% total annualized rate of return. We can see here there's been a small dip down in the analyst estimates of AFF. Not as great as it's been with some of the other residential REITs, but certainly something to keep in mind. Expectations here are for some increases here in the dividend from the analysts. And so this looks like it could be an interesting opportunity for a reasonable dividend yield, a reasonable S&P credit rating, but perhaps, as we can see here, from the historical tab here, perhaps not a lot of opportunity here for dividend growth rate going forward. Essex Property Trust, we can see here 2010 to 2019, some very strong AFFO growth. Now, this is BBB plus credit rated. It does have a slightly higher debt to capital ratio, which I think some investors and analysts have been very wary about. It does have some very nice analyst scorecards here, which I do love to see. I think this is probably the best of what we've seen so far. Dividend yield is a little bit lower at 4% at this level, and we can see here that the prices are trading between the orange and the blue line. So visually we can see this hasn't really been happening too much, so this might be a reasonable time here to get in. Dividend growth rate, we can see recently again, like we've seen in other cases, low to mid single digits. Again, we can see it's generally underperformed the S&P 500 since 2007, although again, with roughly almost twice as much, I think, dividend payments coming through. In terms here of forecasting calculators, taking out to the end of 2025, we can see some drop in AFFO, growth 24 and 25 financial years that are being estimated by the analysts, but not too big a drop, I think. We can see a little increase here in the expected change in AFFO, and if prices return here to even a 19 to 20 times, we could be talking about a 10% annualized rate return. So I think a moderately good opportunity here, one that I'll have another look at soon, although I've got to be honest, this long-term debt to capital level ratio is a little bit concerning to me. It's a bit higher than what I'd want to see. Invitation Home. So we can see some fairly good AFFO growth there, BBB rated. Again, slightly higher long-term debt to capital levels. Dividend yields of about 3%. Some pretty good analyst scorecards here. Difficult to say here. There's not a lot of history here, so I'm not going to worry too much about these dividend levels. But we can see here that the dividend payout ratio appears to be quite elevated, and there's been this decline in prices here. Now, 10 analysts following it, we can see expectations here for the AFFO is actually fairly stable over the last 6 months in comparison to some of the other analyst expectations and some of the other companies. If it does return to 26 times, I think it's quite a rich AFFO ratio. Even if we take 23.5, talking about a total annualized rate of return of about 11 to 12% per annum, which could be reasonable. One of the big questions is, can the prices recover and can we hit this price to AFFO ratio again at 26 times? If so, that could be a strong performer. As I said, the payout ratio here is looking very elevated. I'm curious to see what happens in the future. This might be, an Invitation Homes might be one case where I do another video and just dig into this in a little bit more detail, see if I can figure out a little bit more about what's going on here. Mid-America Apartment Community, so A-, fairly reasonable long-term debt to capital ratios, some exceptional analyst scorecards, so this is what I like to see. Stability here. We can see a long-term history here of AFFO growth. We can see a 4.5% dividend yield. In terms of long-term performance, we can see recent increases here in the dividend. It's been put up by basically mid-single digits every year, with the exception of the last couple of years where there's been strong increases here. And a beautiful thing here is the total compound growth rate has been very similar to the S&P 500 historically. So I think out of all of the options we've looked at so far, this is looking quite nice indeed. Forecasting calculators. Normal price to AFFO ratio of about 21 seems reasonable. So if we look at this, there's been a reasonable decrease in the analyst estimates for AFFO in 24 and 25. 2024 looks like it's going to be more or less flat in terms of AFFO, with a small increase here of 4% in 2025. And if prices do return to this level of 21 times and a price to AFFO ratio, we're talking about a total annualized rate of return of about 22%, which I think is quite achievable. I love the analyst scorecard. This is definitely going on my list of companies to look at investing in next. Sun Community. So again, we can see this massive level of overvaluation here that we've seen with other cases. We can see a nice strong AFFO growth here over the last decade. BBB rated, high elevated long-term debt to capital, moderately good analyst scorecard here, and a 3% dividend yield. Dividend performance has been fairly consistent here in terms of the dividend growth rate of about 5% per annum. It has performed better than the S&P 500 over the last since 2008. Forecasting calculators, the normal price to AFFO ratio of 29 times I think is quite elevated. If I take this down to about 23 times, which I think is still elevated, we're talking about a 17.5% annualized rate of return, but we can also see here some really big revisions downward in terms of the AFFO from the analysts. But 2025, they are expecting a reasonable increase here in the AFFO. So that could be an option, but again, I'm not 100% sure I feel comfortable with this long-term debt to capital ratio. UDR. So this is a final residential REIT here. We can see since 2011, fairly nice, consistent growth in the AFFO. High long-term debt to capital ratio here, BBB plus. Dividend yield here of about 4.5%. Exceptional analyst scorecard, so that's what I like to see. Dividend growth rates have been a bit variable, but low to high single digits in the recent past. Since 2007 in comparison to the S&P 500, it's returned less overall, but obviously, like many REITs, more dividends have been returned in total. Forecasting calculators, normal multiple. So here is 22.3 a reasonable multiple, maybe, even if we drop it down to about a 20 times price to AFFO multiple, we're talking about a 17.8% annualized rate of return. Is this reasonable? Analysts revised down the AFFO estimates a little bit in 2024 and 2025. And it could be that we're looking at some other revisions again soon. I do think the long-term debt to capital level is a little bit high, a little bit pricey for me. So this is possibly one that I'd just be avoiding on the basis of that as well. I'm keen to hear what you think. Are any of these on your watch lists? Are any of these going to be companies that you do a deeper dive into? And if so, which ones? As I've said, a couple of these have got me a little bit interested, and so I will be going through some of these in more detail later on. Hit me up in the comments down below if you want me to provide a more in-depth, detailed video going through much more of the fundamentals for one or more of these companies. Let me know and I'll do my best to help out.